Hello everyone. In this video I am going to discuss about currency crisis models. There is three currency crisis model, which is first generation model, second generation model and third generation model. There is another generation model which is called fourth generation model. Fourth generation model is still under construction, so I will not discuss about it. So let's get started with by first generation model. First generation model was built by Krugman in 1979. This model is also called exogenous model because it's primarily focused on exogenous shocks and factors that can trigger a currency crisis. This model is applied in developing countries. There was inconsistency in fiscal and monetary policy. Government tried to maintain fixed exchange rate, which influenced speculators. We will discuss about speculators in later. Now I will discuss about reasons for crisis of first generation model. Krugman assumes that government operates fixed exchange rate and runs budget deficit by domestic credit expansion. Here, domestic credit expansion means increase the supply of credit or loans among the current country's domestic system. So, under this circumstance, they had to print money, which affects the interest rate drop down and capital in outflow increase. That gives the pressure of devaluation. So central bank defend this by foreign exchange reserve, and which became critically low as they were attacked by speculators. Here speculators can be a person or a agent or an organization. So normally speculators buy when the price is low and resell it when it is high. There are two types of speculators: stabilizing speculation and destabilizing speculation. Attacking speculators buy precisely when price is rising in order to force further rise and then further profit from the difference is called destabilizing speculation, which is important to know. Now we deep dive into second generation model. This model known as endogenous policy model because it places significant emphasis on internal policy related factor within a country that can contribute to the currency crisis. This model is applied in industrial countries like in Mexico in 1944 crisis and Europe in 1990s. There is difference between first and generation model is that second generation model government seeks to minimize some sort of loss function, for example derivation of output or inflation rates from their desired levels. The reason for crisis of second generation model allows the possibility of private sector anticipating a devaluation that can increase the cost of government for not devaluing. As a result, it becomes rational for the government to devalue. If the private agents' expectation of devaluation are high or low, the cost of maintaining a fixed cost rates are high or can be low. So it's play symmetric role, and hence the government has lower incentive to devalue if the private agents' expectation of devalue are low. Private agents' expectation can be self-fulfilling if there is an exogenous shock to their expectation. So they move a low to high risk of devaluation, thus the probability of devaluation will rise properly. Here is the three key components of second generation model. They usually are government preference, specification of the real variable, cost of devaluation. Government preference. In the second generation model, the cost and benefit to the authorities of maintaining a fixed exchange rate are continually reviewed and modeled. For instance, a sudden increase in expectation of devaluation might lead a higher wage demand and a raise in the real wage in short term, which leads to fall in output below the desired level. Specification of the real variable. Different second generation models specify different real variables what are affected by an expected devaluation. This may be the level of output, the level of employment, or the real level public debt. An expected devaluation is likely to lead a fall in output or rise in unemployment or the cost of servicing of public debt, since an expected devaluation raises the required interest rate. Cost of devaluation. The second generation model assumes that there is a fixed difference. If the government is forced to devalue, then there will be a given cost to it, and this cost might be seen as a loss of political prestige due to failure to carry out the stated fixed exchange rate policy or loss economic credibility. When first two generation model cannot explain, there emerged third generation model. Third generation model, mainly called twin crisis because it included financial crisis and currency crisis both. The main cause of third generation model is called moral hazard. Moral hazard refers to a situation where domestic firms engage in excessive investment because they act as if their investments are protected by government intervention. In times of trouble, these firms anticipated that the government will come to their rescue and prevent bankruptcy. We will see an example of moral hazard. Say there an investment project requires an investment of 80 million USD will generate a profit of 40 million USD with a probability of 40% and a loss of 40 million USD with a probability of 60%. So you can see the expected return from the project is 8 million loss. Clearly, this project will not be undertaken. However, if the government guarantees investor that if the project does not success, there will be 60 million profit. There are other causes like financial fragility and balance sheet problem as well. So this is about third generation model. I hope you like my video. Thank you.